Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Rob, I know you have had a busy week. What's going on in your world?
Yeah, busy week. Last week I was on the East Coast again, Wilmington, Delaware, with a client, cool client called Carver Ties. So I'm always key on, get their names out there in any way possible. So check out Carver Ties. I think it's gonna disrupt the advertising industry, which is interesting. But was out there, not as much travel as you. I'm now back in Southern California. Since the last time we spoke, for everybody that's out there, obviously the fires, different craziness here. It's a little further north than where I'm at, Gary, about 20-25 miles, but still close enough. And I know those communities, just devastated. But we're hanging in there as best as we can. And I know you've been traveling a ton, so catch us up to speed on that.
Sure. Yeah. By the way, first of all, our hearts go out to the people in Los Angeles and in California. Rob, so glad to hear you and the Flying V family are safe. On my end, last night, I traveled from Chiang Mai, Thailand to Ho Chi Minh City, Vietnam. Older Americans will remember it as Saigon. But when you get here, everybody asks what district you're from. I'm in District 1. Someone will say I'm in District 4. So it's possible that I have somehow traveled to Pan Am. And but I just want to let you know that if a version of the Hunger Games breaks out, I'm volunteering, because who in the world would want to miss that? That seems kind of fun. But I will tell you, I had a really interesting travel story on the way here. About 20 years ago, I was in Colombia, and I took an extra minute or two. I was having trouble getting change for my cab driver. Walked into the airport in Cartagena, Colombia, and there was no line. I walk up to the front, and I was like half a minute late for official check-in. And the person from Spirit Airlines would not let me check in. I said, look, there's no one here. What's the problem? And they said, well, you're not going to be able to get through security. They don't have time. And I said, hold my beer. I walk over to security. There's nobody there. I explain myself to the head of security in the Cartagena airport. The guy says, no problem. Let me come with you. Walks out of security, comes with me, goes to the counter, says to the Spirit Airlines person, this is not a problem. We're not busy. We can get this man through security. It's no problem. Check him in. The Spirit Airlines person refused, would not check me in. And I lost an entire day because they were obstinate. Now, in the 20 years since then, I have spent thousands and thousands of dollars traveling on every airline but Spirit. I have not set foot on a Spirit flight since then. Last night, I had a connecting flight through Bangkok, and I was connecting to Vietjet Air. It's one of Vietnam's national carriers. And because my connecting flight was late, I was running through the airport. And when I tell you running, like I'm racing through, dodging around people. Finally, I get to the counter. It is less than an hour for an international check-in. I'm covered in sweat, breathing hard, got my bag trailing behind me. And these lovely Vietnamese representatives, they see me and I'm like, I'm so sorry. My flight was late. I know I'm late. And they're like, don't worry. Everything's fine. Give us your papers. Give us your passport. 5 minutes later, they're handing me a boarding pass, wishing me well. I got there on time. They couldn't have been nicer about it. And I will, of course, fly Vietjet Airlines again. And I think that tells you a lot about customer service. Now, here's where I'm going with that. At Deep Knowledge Investing, we treat our clients, our customers, our subscribers like that is all that matters. I hate the idea that we might have somebody in our family who has a bad experience with this. And Rob, that's where I want to thank you and Flying V Group. When I am halfway around the world, on the rare occasions that something goes wrong, that we get a customer service request, that somebody has a problem, that one of our subscribers needs something, everyone, I just email Rob, and somehow everyone, either Rob himself or someone at Flying V, treats it like an emergency. And instead of people being upset that they have a problem, I get emails saying, wow, you treated me so well. I will never leave. And so, Rob, I want to let you know that you and Flying V are the Vietjet of the marketing world. And somebody else is playing Spirit, but it's not you guys. So I just want to thank you publicly and thank the team, Alex, Jonathan, Robert. You guys have so many. I know I'm forgetting 10 people, but so many great people there, and I just want to thank you guys publicly because last night I had the experience of seeing the difference between great customer service and horrible customer service. And I know, that you protect me and my business with the people who matter to me. So thank you so much.
Thanks, Gary. Yeah, that means a lot. Really appreciate that. I know that's one of the things we do pride ourselves on, right? Probably not going to be the best at everything, right? You're not going to have the answer to everything, but it's the effort, right? The trust, the compassion about our clients. I think that does make all the difference. So, Flying V Group, not the Spirit Airlines of marketing agencies. But we've got, Gary, a great episode of this week's 5 Things. I know you're traveling. We're talking 15-hour time zone difference right now, which is really fun. Gary's living in the future for us. We've got the currency and debt problem issue of this week's 5 Things. We're talking about debt crisis, Fed rates. Again, as always, we're talking BRICS, Macau, and liquidity for our 5th thing. Gary, you ready to rock and roll?
Let's go.
Thing number 1, Gary, we're heading for a debt crisis, and that's not counting BNPL, which we've talked about in previous editions of the 5 Things. Gary, thing number 1, an American debt crisis.
Thanks, Rob. So one big theme here on Deep Knowledge Investing that we've talked about on this show for about 2 years is a bifurcation in the American economy. What we've talked about are a small number of people who have portfolios and assets and credit scores that position them to do really well in inflation. So think about it for a minute. We've all seen the price of assets go up. And if you had the wherewithal in your household to do things like take on debt and buy a house, take on debt and buy gold, to buy Bitcoin, to buy stocks on margin, you were short the US dollar, which has been declining in purchasing power, and you were long hard assets, which have all gone up because of inflation. Now, for those few people who have been able to do that, it has been a great economy. But for the rest of the country, they have been struggling. Inflation is horrible for most families. It just makes it difficult for people to pay their bills, and a lot of the country is struggling. And over the last couple of weeks, last couple of months, we have started to see that in some of the debt statistics. And so recent data has shown US credit card, auto loan, and commercial office defaults are peaking to levels we haven't seen since the great financial crisis. And this is a gigantic problem. Now, listen, these things wax and wane, they go up and they go down, but anytime you start to see huge spikes in defaults or delinquencies, you have a problem because those people are not going to pay their bills, and that's going to create a problem for the people who lent to them. We saw in the third quarter over $24 billion in credit card balances added. That's up 8% from a year ago. Reports are showing that 36% of consumers took on debt during the holiday season. One of the things we've said before, lower income households, they ran through their COVID stimmies years ago and are now they're tapped out. They're starting to take on more debt. And this financial distress has been spreading. And so the delinquencies are up so much, $46 billion in loans were written off in the first 3 quarters of 2024. Based on the charts I'm looking at here, on the credit card loans, it looks like delinquencies from 2.5 years ago were just over 1.5%. They're now over 3%. That is a gigantic increase. On the auto side, it's even worse. Those delinquencies have gone from about 5% to almost 8%. So, Rob, there are a lot of Americans really having a hard time right now, and those problems are going to be pushed on to the lenders and the credit card companies and the financing companies.
Yeah, Gary, you mentioned commercial delinquency rates. Those are at an all-time high of 11%. And then we look at the collateralized mortgage-backed securities. That's rate spiked to 6.6% of delinquencies. And then you also, and I mentioned it in the subheadline, the buy now, pay later loans, those are growing fast as well. How bad is it, Gary, or how bad do you think it is? What is the landscape? What's your message to DKI subscribers?
So let's actually talk about how bad this is. First of all, the CMBSs, the collateralized mortgage-backed securities, if that sounds a little bit familiar to people, those were the financial instruments that blew everybody up in 2008. Now, when
Right.
you hear 6.6%, is that awful? Yes. And the reason it's awful is because by definition, those securities are leveraged. So it's not 6.6%, it's 6.6% of a gigantic number. There's not enough equity there. And that can cause different tranches, different segments of these securities to go to zero. Office delinquency rates at 11%, that is an all-time high. Right, that's not a recent high. That's an all-time high, and buy now, pay later. I've seen estimates that those may be approaching $1 trillion. It's really hard to tell. I'm not entirely certain, but here's the key point: when we see credit card delinquencies starting to spike, and what you realize is that's the high end, the high quality part of it. The buy now, pay later, which is growing really quickly, that's the low end part of it. And just a reminder, last year, they surveyed a bunch of young people, and those people were shocked. They spent money on buy now, pay later, and they were shocked when a month later they started getting bills. Like, how did this happen? Why do we owe money? And they really didn't understand that the store wasn't giving things away for free and the financing company wasn't financing things for free. They were shocked when they got a bill. Now, if people who take things on credit on this buy now, pay later are surprised that they get a bill, Rob, what do you think is going to happen a few months down the road when those bills get too expensive for them?
Yeah, they're not going to get paid. Gary,
Exactly.
sticking.
And those numbers are not included in the statistics we gave you before. So the point is, everything we told you is actually worse than what we're telling you.
Right. Yeah, right. Yeah, very interesting, Gary. We'll again keep eyes on this, something we've been talking about. Talking about the collateralized mortgage reminded me of the scene in The Big Short when they explain the 2007 crisis. But, anyways, moving to thing number two. Again, we said we're talking Fed rate cuts. Fed rate cuts were supposed to improve housing affordability. Thing number two, Gary, exactly that. Fed rate cuts were supposed to improve housing affordability, and I'm guessing you're going to tell me that they haven't.
Yeah, they have not. So, Rob, let's actually go to the basics. Let's just explain things in the most basic way possible. When people go to buy a home, they can afford a certain monthly payment. Now, does it really matter to those people whether that payment goes to principal or to interest? Yeah, it matters a little bit. I mean, it's obviously you'd prefer to be paying less interest and paying down your mortgage, but people mostly go off of the payment. And so that payment will be made up of your interest expense and your principal payment, paying down the value of the loan. And so, when people say I can afford a certain amount and interest rates go up, the way they have to match that is to pay less for the home. Well, that hasn't happened. So back in September, the Fed started cutting. And between September and December, the Fed reduced the Fed funds rate by 100 basis points or 1%, which, believe it or not, is a lot. Now, I'm going to tell you that DKI spent all of 2022, 2023, and 2024 telling the Fed, telling everybody, do not cut rates, do not cut rates, do not cut rates. It's going to lead to more inflation. And well, guess what? The Fed cut rates, and ostensibly what they were saying is, we want to improve the economy by lowering people's borrowing rates. And they also wanted to reduce people's mortgage payments, saying, hey, we're going to make housing more affordable. If we lower rates, then the interest portion of people's mortgage payments will be lower, and that will lower their monthly payment. And that would make sense, except what happened was the bond market, who are not, the bond market tends to be very smart. And the bond market said, wait a minute, the Fed is lowering rates, we're projecting more inflation. And instead of mortgage rates coming down, the yield on the 10-year security actually rose by 100 basis points. So instead of doing this, everything went like this. And again, that created a problem. And so the 30-year fixed rate mortgage is now above 7%. Now, just to give you a sense, when I refinanced my mortgage in late 2021, you could refinance right around 3%. There were people at, 2 7/8, 3 1/4, but right around 3%. And so what we have seen is that housing prices are up, rental prices are up, mortgage rates are up, and that has all happened into a housing market that was horribly unaffordable for most Americans. So, as we put it in the written version of the 5 things, what could go wrong?
Yeah, Gary, we just recently released one of our older ebooks. We obviously made some updates, but takeaway in this week's 5 things, we're talking about the ebook we wrote a couple of years ago, about a year ago, Counterintuitive Inflation, explaining kind of the phenomenon, what's happening. I feel like we're just going to be re-releasing all of our work over and over as we get closer to these events that you've called out so early on. But Gary, tell us more about that and why the Fed is just stuck or trapped.
Yeah, thanks, Rob. So, by the way, for anybody who missed it, that ebook called Counterintuitive Inflation, we released it over a year ago, and it actually did predict what happened and explains what's going on. If you want a copy of it, we have given it away for free. We've put it out in public. Just shoot an email to ir@deepknowledgeinvesting.com, and I'll send you a link. I read everything that comes into that email address, and I'll send you a link, and you can download it for free. But basically, the way things used to work is the Federal Reserve would, raise rates when they wanted to slow the economy. They would lower rates when they wanted to add a little more fuel to the economy. The problem here is we've had so much overspending out of Washington that the Fed no longer has as much control or impact as they would have had just a couple of years ago. And the reason for that is it's not the Federal Reserve that's creating inflation right now. Now, they haven't helped. They have made things worse. But the real reason for the increase in inflation is trillions of dollars of excess spending out of Washington, D.C. Now, for the partisans in the crowd, this is a bipartisan problem. Republicans spend too much. Democrats spend too much. It's a problem all the way around. But because Congress won't stop overspending, what will happen is with the official debt right now, about $37 trillion, and the outgoing Treasury Secretary, Janet Yellen, she reduced the duration of the Treasury bond portfolio. Now, that's just a fancy way of saying that when the government over the last couple of years had to refinance, instead of refinancing with 10 or 20 or 30-year paper, they refinance with a lot of 6-month and 1-year and 2-year paper. And what that means is all of that debt is going to have to be refinanced more often. And so as that debt rolls over and 1 or 2% debt is replaced by 4 or 5% debt, it increases the interest expense that Washington has to pay. Now that's well over $1 trillion a year. Well, if the government is overspending and we need to pay more interest, how do we do it? Well, the answer is they roll the debt and they print more dollars. Well, guess what? It was dollar printing that created this inflation problem to begin with. And that's why the Fed doesn't have control. If the Fed increases interest rates to try to get inflation under control, all that means is that Congress and the Treasury are going to need to create more dollars to pay a higher interest expense. This is something that we've called counterintuitive inflation. Lynn Alden, who I respect a lot, has called it fiscal dominance. But the Fed has lost control of all of this, and the answer is nobody panic. Nobody. I mean, we can get upset about it, but it won't help. The answer to this is prepare your portfolio for more inflation. It is on the way. There is nothing they can do to stop it. It is baked into the system now. And, for people who are having difficulty or saying, wait, I don't know how to do it, guess what? This is what we do all day, every day. So, feel free to reach out to Deep Knowledge Investing. We are helping people deal with this problem right now. And I will just remind you that you don't have to lose value. There are things you can do in your portfolio to not only survive this, but to take advantage of it and make money from it.
Yeah, great stuff there, Gary. And again, if you'd like a copy, ir@deepknowledgeinvesting.com. We'll be managing that inbox and be sure to get you any of that material that you might be looking for on the counterintuitive ebook that we wrote about a year ago. This is this week's version of the 5 things, the currency and debt problem issue. I'm here with Gary Brode. Please head to our website, deepknowledgeinvesting.com. Sign up for a free subscription. We'd also love if you considered a premium subscription to allow us to continue to bring you high quality content and information on what's happening in the market on a week-to-week basis. Thing number 3, moving on, we're talking about the dollar. Even without a functional BRICS option, Gary, you call out the dollar is still losing share as a reserve currency. Thing number 3, the dollar is still the world's reserve currency and is still losing share. Gary, tell us more.
So, Rob, this is something that we've been talking about at Deep Knowledge Investing since 2022, 3 years ago. First of all, let's talk about what it means to be the global reserve currency, because that is the dollar right now. And the reserve currency tends to trade hands every 100 or 150 years. And being the world's reserve currency means that your currency is typically the one most held and most in demand by foreign central banks. It's the one that they hold in order to preserve value and settle balance of payments. And so, as a great example, a lot of people talk about the petrodollar, and we actually helped distribute Alex Macreese's book "Running on Empty," where he talked about the creation of the petrodollar and the coming destruction of it. But for many, many years, all oil was priced in dollars. So even if you had two countries that weren't dollar-based countries, if they were trading oil, they were trading either in dollars or based on dollars. Oil was priced in dollars, and world energy is a big deal. So all of that gives the United States both a huge advantage and a disadvantage. The advantage is, people call it the exorbitant privilege, and what that means is that we have, as the United States, have been able to print trillions of dollars of assets out of thin air, send them around the world, and receive goods and services. So literally, we have people here in the US, in the Treasury Department, in the Federal Reserve, they push a button, they create dollars, we send those dollars overseas, and other countries send us their goods. And that's pretty great, right? Well, the problem with it is we end up with inflation and a hollowing out of our manufacturing sector. So, for instance, if where I grew up in Detroit, Michigan, and back in the 80s, when we saw the auto industry switching to the Rust Belt, we saw tons of manufacturing jobs in places like Michigan and Ohio moving overseas, and that our steel mills do not produce like they used to. So these are the kinds of problems that we have now. The dollar is still the dominant global reserve currency. The dollar is still the most attractive currency in the world. However, the big problem is we are losing share, and we're losing share fast. Credit to new DKI intern Josh Reeves. He put up a chart showing that if we go back just to 2016, Rob, the dollar as a share of central bank reserves was almost 66%. It has fallen down to 57%. That is a 9% decrease in under a decade. This is a huge problem. And there are a lot of reasons for that. One is Washington has used the dollar as a hammer. We've used it to try to force countries to bend to our will, to accept our foreign policy prescriptions, and that's fine. We like what we like, and we want to exercise control and influence all over the world. Well, other countries may not be so happy about that. Also, because we've printed so many dollars, we've had inflation, and so lots of other countries are switching to different reserve currencies. They're switching to gold. There's a lot of talk. A lot of countries are looking at using Bitcoin as reserves. And by the way, countries like China and India have been buying huge amounts of gold. They're not doing that because they have faith in the dollar.
Yeah, Gary, you mentioned the BRICS commodity-backed currency about a year ago. Obviously, that talks about, big piece of the population. Why would they want less exposure to the dollar, Gary? Give us more insight into that.
So BRICS is a growing financial coalition. BRICS stands for Brazil, Russia, India, China, and Saudi Arabia. Now, if you take a look, right, India and China, the two most populous countries in the world. Saudi Arabia, boy, are they influential in the energy market. Same with Russia. Brazil, they are an economic powerhouse. Maybe not the United States, but that country has grown a lot. And that BRICS coalition has now grown to several dozen countries, making up more than half of the people on the planet. Now, I started talking about this about a year ago, and I said, hey, this is potentially a problem. And a lot of people said to me, no, it's not. There will never be a BRICS currency. How would they organize it? How would they trust each other? These are countries without common interests. Okay, these are all fair points. And in fairness, a year later, we still don't have a BRICS currency. But the point that I made at the time was not so much that I thought we'd have a commodity-backed BRICS currency by a certain date. The point that I made is that more than half the world wants less exposure to the dollar. They don't like the fact that Washington abuses the dollar. Again, it's not called the exorbitant privilege because people like it. Places like Russia and China are nervous holding dollars because they're worried the U.S. government will freeze their assets. They view us, whether you think it's right or wrong, they view us and they view the dollar as untrustworthy. And so, anytime more than half the world is saying, we want less exposure to your currency, we end up with a situation where, again, in under a decade, we've had a 9% loss of share. That is a gigantic loss as other countries are looking for an exit to the dollar. And the reason that's such a huge problem here is, Rob, want to take a guess what the number one export of the United States is?
I feel like I should know this.
It's
Go.
it's not a trick question. It is dollars. We export
I
more.
actually was going to say dollars, but that seemed like a trick question that you were leading me into. And it's too late at night here, Gary, for those questions.
Don't worry, Rob. We're going to get you a free subscription to Deep Knowledge Investing, and you're gonna be fine.
Obviously
Yeah.
based on the question or the topic and the thing, I was going to go dollars, but then I was like, I'm gonna let Gary answer this. Make sure I don't put my foot. I don't want to become a
Yeah.
meme, or maybe I do, right? Because I am the marketing guy, so that'd be great.
There you go. No, it really is dollars, and so
Yeah.
this kind of dollar avoidance by other countries, that can change our trade policy, our foreign policy. Um, our ability to use the dollar. Right now, Washington is using the dollar as a weapon. Um, and that's not a great way to use it. It would be better if we were to use the dollar for influence. And somebody might say, hey, you're sort of playing around with it. And yeah, there's a little bit of language artfulness in that. But I don't think it's the same. Rob, there's a huge difference between me saying, hey, Rob, I really love working with Flying V. If you could help me with this, I'd really appreciate it, and I could do this for you, and let's collaborate, right? That's one thing. To say, Rob, if you don't do what I want, I'm going to use my assets to hurt you and freeze your dollar assets. That's a very different thing. And so, the more share the dollar loses, the more influence we lose in the world. And right now we're running a pretty expansive, aggressive foreign policy. So something's going to have to change along the way.
We'll keep you in touch and in tune with or when or what changes here on the Five Things. Gary, moving to thing number 4, talking Macau, LVS, Las Vegas Sands, DKI portfolio position. Gary, thing number 4, Macau gross gaming estimates aren't wrong, just misleading. Tell us what we need to know.
So last week, Rob, a sell-side analyst upgraded his estimates for Macau gross gaming revenue and his price target for Las Vegas Sands. Now, I'm going to be honest, I've always loved poking at the sell side. I think, it's not such an honest business model. They're not really direct about what it's marketing trying to sell investment banking services. You, if you're reading sell-side research, you're not the customer, you're the product. That said, this is not a situation where I want to poke at the analysts. I actually think this particular analyst did good work, and I agree with their work. And so, we're not poking at them today. But we should talk about what it means, what kind of estimates they put out. So Macau is the gaming capital of the world, is a territory of China. And it is much, much larger than Las Vegas and Singapore and the Philippines and other places where gaming is big and legal. And so gross gaming revenue is basically just a measure of how much money is wagered at the gaming tables. And so what this analyst said was they expect a full recovery of Macau's GGR, their gross gaming revenue, to pre-pandemic levels by 2026. Well, hey, that's next year. That sounds pretty good, right? Okay. That estimate might be correct, but it's misleading. And again, I'm not picking on the analyst. I agree with his analysis here. But the reason that gross gaming revenue is down right now is because the big spending VIPs haven't fully returned to the casino gaming tables in Macau. And because they are such big spenders, such big gamblers, that has held GGR levels well below the 2019 mark. Now, that's a big problem for companies like Wynn that focuses on the high-end consumer. But that's not the case for Las Vegas Sands. Sands does most of its business in the mass and premium mass markets. And the reason that matters is because those markets are much higher margin. Based on calculations we've done, $1 gambled at the tables by a VIP is worth about 1/10 of $1 gambled at the tables by somebody in the mass and premium mass market. So in those areas, Macau has already seen a full recovery. The mass and premium mass markets in Macau have recovered to pre-pandemic highs, and Las Vegas Sands already has several properties, both in Singapore and in Macau, that are performing at all-time highs. Now, somebody might say, wait a minute, there are a couple of those properties that still aren't doing great. That's true, but the reason for that is some of those properties have hundreds and hundreds of rooms out of service right now for renovations. Now, casinos, hotels, they need to be at a very high end. They need to be, beautiful and well-maintained. And the nature of these places are they take a lot of hard use. And so it's normal to take these rooms out of service to renovate them. Well, that's where Las Vegas Sands is right now. And guess what happens this quarter? This quarter, they complete those renovations. So we expect to see the vast majority of Sands properties performing at all-time highs later this year. So I don't think the analyst here was wrong. I just think they gave aggregate data where you need to drill through that and look at the difference between the mass market, the premium mass market, and the VIP market. Again, that's a problem for Wynn, but not for Las Vegas Sands.
Gary, into 25, you mentioned in the takeaway that there's still risk. What are you going to be keeping a close eye in 25 as it relates to LVS?
Yeah, so I think the biggest risk right now in Las Vegas Sands is the Chinese economy. They are actually facing deflation right now. Now, in general, I do not have the same distaste for inflation that most economists do. A lot of economists think deflation is horrible and it's terrible and it's a disaster. But, if you're watching this, let me ask you, would you think it was horrible if the price of your groceries or the price of your car or the price of your clothing went down? Could we manage with that? Of course we could. We'd be fine, right? So I disagree with a lot of economists on that. But the issue here is the reason the Chinese economy is facing deflation is because their property market has imploded. Now, China has spent years and years and years building up fake GDP numbers. Now, before anybody jumps on me on this, yeah, I know we have talked for months and for years about how US GDP numbers are faked. I'm not saying China is the only one that screws with these numbers. Ours are dishonest too. So I'm not picking on China and ignoring the United States. However, what China has done to goose their GDP is they've built large numbers of basically ghost towns. They built lots and lots of property without people to occupy it. And the Chinese people were storing their wealth in partially built or to be built real estate. And a lot of those companies have gone bankrupt. Their banks are over leveraged. They have had a property bust that, the numbers I'm seeing are actually worse than the 2008 financial crisis in the US. Now, just a reminder for people who are maybe a little bit younger and don't remember, in 2008, the financial world didn't fall apart. It was the property market, and that pulled down the equity markets. But the amount of money lost in the US equity markets in 2008 has been exceeded by the losses in China. And, in 2008, in the United States, most of that money was held by large financial firms. But in China, the average citizen has a ton of exposure to the property market. So all of this means that if the Chinese economy gets worse, people will have less money to go to Macau and gamble. And if that's the thing we're going to be watching, if that happens, that won't be good for Las Vegas Sands. So I'm not worried about the overall gross gaming revenue numbers. Right now, the mass and premium mass markets are very strong. Sands properties, once you back out the renovations, are doing extremely well. But we're going to be watching closely the situation with the Chinese economy and the property market there, because that could create a problem for our thesis. And listen, if we need to sell the stock, we'll be selling it at a profit. And, instead of recognizing big gains, we'll recognize smaller gains and just look for a better entry point in the future. I don't think we're there yet, but we'll be watching it. And, one of the great things about being an investor is the ability to say, I no longer agree with my own thesis. I'm going to sell the position and go find something else.
Yeah, perfect segue into joining the DKI Premium subscription. You'll get access to all of our current recommendations, open position that Gary has in his portfolio. Most importantly, though, understanding when to close out or when Gary's closing out those positions for your consideration. Premium subscription on our website, either monthly or yearly options. You can always sign up for our free subscription as well. But that will not get you access to paywalled content that you really want to see. Wrapping up this week's version of the 5 things, the currency and debt problem issue. We're getting to our investor education thing number 5. Gary, today we're talking about liquidity. I'll break this one up and just start, Gary. Thing number 5, how much does liquidity matter?
Well, so first of all, Rob, huge credit here to new DKI intern Josh Reeves. He wrote this section, and I think he did a great job explaining it. His first sentence here: liquidity refers to how easy it is to turn an asset into cash without significantly affecting its market price. I think that sentence is phenomenal. Josh really captured it. So let's think about the things that many of us own and what it would entail to buy more of it or to sell it. So for instance, let's say you have real estate, art, a car, jewelry. If you wanted to sell that or buy it, the bid offer spread is enormous. And frequently in real estate, or at least home real estate, transaction costs can be as much as 10% of the transaction. In the auto market, we've all heard the statistic that you buy a new car, you drive it off the lot, now it's a used car, it's worth 30-40% less. If anybody wants to have an experiment on this, go to a used car lot or a new car lot, buy a car, drive it for a week, treat it well, take it back, and ask how much you can get for it. I guarantee you it is going to be a much lower price. And so these assets trade with a very wide bid offer spread. You will have to pay a lot to buy it, and you take a big discount to sell it. And these things tend to be illiquid and not frequently bought or sold. And the market isn't as deep, and that's okay. And by the way, the jewelry market is very much like that. Go buy your wife a diamond ring, and then a week later take the same ring back to the jeweler. I promise you that diamond will be the same diamond, but that jeweler is not going to give you the same price. So moving up a little bit into the liquidity, along the liquidity lines, deeper markets might be small cap stocks, where, if you want to buy a lot of it or sell a lot of it, you're going to move the stock price a lot. And then, you can move to really liquid assets like US Treasuries, big stocks like Nvidia or Apple or Microsoft, where, those stocks just trade billions of dollars a day. And when that happens, you can buy or sell large amounts without having much of an effect on the stock price. And so when we talk about liquidity, all we're talking about is the ability to trade in an asset, to buy or sell an asset without pushing the stock price around that much. And typically where the bid offer spread, where the difference between how much you pay to buy and how much you receive to sell isn't that wide.
Gary, follow-up question talking about like asset prices. How does liquidity affect the actual price of the asset?
So it can have an effect in a couple of different ways. So the less common way is a lack of liquidity in a market where you want to buy can actually send the price up. So, you see that sometimes in the art market. Maybe you have an artist that only has a few dozen paintings out there, a couple hundred paintings out in the world, and for whatever reason, that artist, their paintings have become more popular, and the price of that will go up a lot. There are more people trying to buy than there is supply available, and so those assets can get more expensive. Now, in the financial markets, we tend to see the opposite. In the financial markets, there's what's called a liquidity or an illiquidity discount. And that's the reason why small cap stocks will often trade at a multiple discount, right? You pay a lower multiple of earnings or revenue or cash flow or EBITDA for small cap stocks because they tend to be less liquid. Now, would we do that? Sure. There are times that I invest in illiquid stocks. And the reason I do it is because I really like the opportunity and the amount of growth that I can buy, the quality of the business that I can buy, I think outweighs the penalty of owning something that's less liquid. And so, it's okay to buy something that's less liquid, but you want to be careful about two things. One, you want to buy at a discount. You want to ensure that you're not overpaying for something that would be difficult to sell. Two, you really need to nail the timing. So for example, let's say I'm making this up, let's say you have a debt payment coming due in 6 months. Don't go buy lots and lots of small cap stocks that you'll have difficulty turning into cash, to pay that debt down in 6 months. You need to, if you're going to own illiquid assets, what you need to do is ensure that you have the staying power to hold those assets for a long time. Now, there's a difference between liquidity and volatility. So for example, I'm a huge Bitcoin owner. Now the Bitcoin market is very deep, but also very volatile. So you may buy Bitcoin and that price may move 5, 6, 7% in a day. It may move 10, 15% in a week. But if you want to sell it, if you want to buy it, you can pretty much do it without pushing the price around that much. So understand the difference between liquidity and volatility. And if you're going to buy illiquid assets, and it's okay to do that, just be aware you need to get the timing right and you want to buy at a discount. And that's the way I think about these things, and the way I would recommend that you at least consider these things before you put a large amount of your hard-earned capital to work in assets like this.
That concludes this week's version of the 5 things, the currency and debt problem issue. Gary, as always, a pleasure doing this with you. We'll be here same time, same place next week. This week we actually did the recording on Riverside FM, which we're really excited about, trying to just up the overall quality and output, and getting more of the content actually out to you in those versions that everybody seems to love, short, quick, social media, as well as the breakout of the 5 things. Gary, it's been a pleasure. I'll leave you with the closing thoughts for this week's 5 things.
Well, Rob, thanks so much for doing this with me. I know we are 15 hours apart. And then as soon as we finish this, I'm going to spend a few hours getting some work done and then finally get out and get to start to explore Ho Chi Minh City. Again, many of you may know it as Saigon. And, like I said, I'm in District 1. So should I find I'm actually in Pan Am and a version of the Hunger Games breaks out, I'm definitely joining. So if you don't see me next week, it means things didn't go well. But, these are risks you have to take when you travel.